Howdy, Jacob here. Today we're looking at AMN Healthcare Services in the healthcare provider and service industry. 2.3 billion market cap on 3.6 billion enterprise value. 11 PE, so currently looks pretty cheap, and we see that it's not even because operating margin is the highest it's ever been, but it is higher than what it was pre-COVID. So we're looking at operating margins in the upper single digits and a bit higher than they were 10 years ago. Gross margin also a little bit higher at low 30%. Revenue growth was very strong. They must have had a COVID hit where they produced something related to COVID, I presume, based on the fact that they grow 66% in 2021, 31% in 2022, and are actually down in 2023. But if we look at a normalized pre-COVID level, it looks like it was upper single-digit revenue growth. So very impressive. Return on invested capital is probably averaging low double digits, low teens, maybe 12, low teens type of thing. Balance sheet shows 33 million cash on hand with no short-term debt, 1.3 billion long-term debt. So the debt is way higher than what it was 10 years ago. Long-term debt was about 149 and is now 1.3 billion in 2023. I wonder if they make acquisitions. Okay, quite a bit of acquisitions we see, and it looks like they're buying back shares very heavily as well. So they went into debt, it looks like, to fund a little bit of the acquisition and to fund their share repurchases. So their use of cash is really going to be over 100% because they're going into debt to fund some of these projects. But we see a heavy amount on the acquisition side, reinvestment side, as well as share repurchase side. So we see capital expenditures are increasing. They're over 5 times greater than what they were in 2014. And that's a little bit through acquisition, a little bit through reinvestment. And then recently they've been buying back a very heavy amount of shares. Share count has gone down in the last 2 years, from 48 million to 39 million. So very heavy on that. But they're going into debt to fund it. So that 425 million is greater than what their last year free cash flow was. And on a 5-year average basis, you're looking at about maybe 250. So that, going back to that debt as well, that 250 is over 5 years of their 5-year average free cash flow. So we are looking at a good amount of debt there. And let's get ready to make some assumptions here. So on the revenue growth side, I'll probably go closer to over here, that upper single digit range. And then for margins recently, I'm not going to presume they're going to hit back to that 12% range. This operating margin of 8% seems pretty reliable. So let's maybe go 7 and 8%. And then for share change, 1% would be 23 million, 1% to offset stock-based compensation, looking at about 40 million. And I mean, if they were to do 100 million, that would be about 84%. So let's say 3%. So 3% share buybacks would be about 69, 70, 89, about $90 million in aggregate for share repurchases, which I think is pretty reasonable. They're going to have to focus sometime in the next couple of years, very likely, on that debt reduction. They're not just going to be able to refinance everything. And so that 90 million would be about a 40% payout ratio for them, which to me makes sense. And then that leaves maybe 40% for acquisition, 20% for debt pay down. So I'm pretty comfortable with that assumption. Terminal PE, the growth over here from acquisitions. I mean, somewhat efficient with their acquisitions and good return on invested capital. Let's go 17 there, 15% return. And wow. Okay, one more thing. I'm changing the PE a little bit. So again, I wanted to change it based on them having a lot of debt. So recently I've been changing PEs based on based on their debt rather than their market cap. But even still, I mean, we're looking at a buy now. So I'll be doing some research here and seeing how comfortable with these assumptions I am. But for now, I mean, all that debt is just kind of annoying. But I mean, it says to buy, so I'll definitely look into this company. Hopefully, in the next couple of weeks, come out with an in-depth video, and we'll see whether we feel good about these assumptions or not. So, thank you, and I hope you have a great rest of your day.